Shares of the trade desk are plunging in early morning trading on Friday after the company reported its Q3 2023 results. What happened this quarter that has Wall Street in a tizzy? Here's everything you need to know in about 10 minutes. We're going to cover the company's financials, news, and valuation. My name is Brian Feroldi. As of the time of this recording, I do own shares of the trade desk, a $37 billion company. Revenue this quarter grew 25% to $493 million, exceeding Wall Street's estimate and management's own guidance. Earnings per share on a non-GAAP basis came in at 33 cents, growing nicely from the 26 cents earnings per share in the year-ago period, also beating estimates. So strong start to the report. Margins this quarter were mixed. Gross margin was down ever so slightly to 81.1%, down 110 basis points year over year. Operating and net margins both expanded ever so slightly to 7.6 and 7.9%. These are all GAAP numbers, please note. Free cash flow for the 9-month year-to-date end period was $486 million, up very nicely over $339 million last year. This is a free cash flow machine. Net income on a GAAP basis just about doubled, more than doubled to $39.4 million. Balance sheet remains perfect, $1.52 billion in cash, zero debt. Digging into the numbers a little bit more, we saw a nice jump in revenue, but we also saw operating expenses continue to grow. No surprise there, big jump in technology and development spending as well as sales and marketing spending. So this company continues to invest in itself. Overall income from operations grew nicely year over year. Note that total other income on a net basis actually jumped to $19 million. This is a negative number, but a negative. So this is a positive contributor here. This is likely due to the rise in interest rates given the company's huge cash hoard. So that is one reason why income before taxes jumped so much. Meanwhile, the income tax rate actually declined. The company's income tax rate declined quite sharply year over year. This is a more normalized number. So that is how net income on a GAAP basis more than doubled year over year. Now, it is worth noting that this company continues to pay quite a bit of stock-based compensation, $139 million this quarter, up from $122 million in the same period last year. Now, $139 million in stock-based compensation. The company did buy back $90 million worth of its stock during the quarter, but it issued more stock than it bought back. As a result, the share count rose to 502 million, up modestly year over year. But make no mistake, this company is buying back stock, and those stock buybacks are barely even covering the dilution rate. So I don't think that's the best use of capital, especially at today's prices, as we're going to get into, but that is what the company is choosing to do. Now, customer retention remained over 95% for the quarter, as it has been for 9 years. This company's products remain very popular. Unified ID continues to build support with lots of new signups. So why are shares plunging? It really gets down to this. Management noted that they've seen more macroeconomic uncertainty at the start of Q4, and they are guiding for $580 million in revenue. Why are they seeing some uncertainty? They noticed that they saw a slowdown in October by some brands such as automotive and consumer electronics. This they blamed on the strikes in the U.S. auto industry, and that has recovered slightly in the first week of November. The company continues to gain market share, but it is showing a small slowdown in growth. And that is where Wall Street is puking up these results. Revenue guidance for the upcoming quarter is $580 million. That's only 18% year over year growth. They were expecting 611, so that's quite a big delta between those two. Management does not give earnings per share guidance. Wall Street was expecting 44 cents. I have a feeling that number is going to be coming down. So there you go. That is why shares are declining so much today. Now, management does not guide for the full year. Wall Street is estimating 23% revenue growth for the full year and $1.24 in earnings per share. That number is also likely to come down. What is the thesis for investors today, and what should they keep their eye on? I think you should watch revenue, margins, buybacks, and that unified ID. Those numbers are all heading in the right directions. Is the buybacks the best use of capital at today's prices? I don't think so, but that is what management is choosing to do. The moat here is stable at worst, widening at best. This is a company that is executing very well, taking market share, outgrowing the market, executing just very, very well. The thesis here is still fully on track. Turning to valuation, this is a company that has largely optimized its income statement. For that reason, it's somewhere between stage 4 and stage 5, depending on what profitability metric we're looking at. For that reason, we can use multiple analysis to judge this company's valuation, and we are going to do so using the sponsor of today's video, which is YCharts. So this is the trade desk's market capitalization, currently $37 billion. It got down as low as about $21 billion about a year ago, and as high as $53 billion in the peak of the bubbleliciousness that price is traded at. Now, on a price to gross profit ratio, this number is about 24 to 25. That is very richly valued. That's a huge premium. However, that premium does seem to be deserved. The price to sales ratio here, currently about 22. It peaked down to about 14, got as high as 64. This isn't all that valuable, but the price to sales ratio in the mid-teens is what this company seems to be trading at pretty consistently. Now, those numbers aren't as useful as these numbers because the company does have earnings to look at. On a trailing price to earnings ratio, and this is GAAP, 295 times. That sounds like nosebleed numbers, and it is. How about on a forward basis? That number drops to just 62, and if you lop off 26% or so from that number, that gets us down to the high 40s. Again, a very high number that is pricing in quite a bit of growth on a price to free cash flow basis, about 74 times on a trailing basis. So make no mistake, even with this valuation shock drop today, shares are still quite pricey. If you want to give YChart a try, just mention my name off at checkout, and you can save 20% in doing so. You can also start a 7-day free trial. YCharts is an incredibly powerful tool. We use it every day. Thank you to YCharts for sponsoring the video. Moving on, there is another way that we can value this company given its stage, and that would be with a reverse discounted cash flow calculator. Let's take a look. I put in the stock symbol here, TTD. Trailing 12-month free cash flow of about $600 million, 2.5% terminal growth rate, 10% discount rate. And if you use yesterday's closing share price of 77, you have to do about a number of about 23.5%. If we assume that the share price currently holds, which is about 56.20, this is the current number, we have to get 19% annualized growth in the free cash flow rate to justify today's number. So 19% free cash flow growth from here. Can the company do it? Well, the opportunity here remains massive. This is a $1 trillion market that the company is going after. It is taking market share. It is growing. It is doing everything well. However, the company is pretty much fully optimized today for free cash flow production. So we won't see that much of these gains from operating leverage. That means the company is going to have to grow its revenue at about a 19% annualized rate over the next 10 years to justify today's price. And if it can do that, investors would earn a 10% return if my model is anywhere close to accurate. Is that doable? It certainly is doable given this company's opportunity ahead, but that is still a pretty heavy lift. Hard to grow your revenue at that high of a rate for that long of a time. I wouldn't bet against this company doing so. I continue to own shares. I'm going to continue to monitor this company's progress to earn an outsized return, a higher than 10% return. This company's going to have to grow at a 20% plus annualized growth rate in revenue from here. I'm certainly hopeful that it continues to do so, but it's something that investors need to watch. Hope you found this video to be useful. If you want to check out that reverse discounted cash flow calculator I just showed you, we have a free link in the video description, so check that out below. See you in 90 days on this one. Brian, out.